All right, Prashant also caught up with Samiran Chakraborty, the chief economist for India City, and spoke to him about his interaction with the global investors and what do they make of this India as an emerging market. Take a look.
You know, India is now the darling among EM countries, and that has been there for a while. I guess we don't need any more convincing on India macros to global investors. In fact, the most common question for us is what can go wrong rather than what can go right. And that's great, and we expect that this will translate into significant amount of inflows into India. We've traditionally seen a lot of equity inflows, but this time around the focus seems to be more on bond inflows. I think most of the fixed income investors that I have met, not just the EM-focused investors, but also some of the global funds, they are all preparing for the bond index inclusion and bringing in money. And I would not be surprised if the actual inflows turn out to be more than what the mechanically arrived at number is. The question really is on equity investor flows. While the positivity on the macros are there are some concerns on valuations. So that's an area where we would probably still have to wait for things like election results, etc. And then the third aspect is the FDI flows, where everyone is looking at their own India strategy, so to say. But again, my sense is that there could be a bit of a time lag between designing that strategy and the actual inflows.
On elections, would I be wrong in saying that consensus does expect Mr. Modi to come back as Prime Minister? There's a little doubt on that?
I think that's where the market consensus is right now. The way I would put it is that the political and policy continuity is already quite well priced in the market. What people are asking us about is the so-called policy delta. What can change after the elections? Are we going to see a significant amount of structural reforms being unleashed? Because in some sense, the whole fiscally conservative control over inflation, manufacturing push, infrastructure push, these are stuff which investors are by now very familiar with in the Indian context and want this to be continued. But are we going to see more of the land reforms, labor reforms, privatization, agricultural reform, those kind of stuff also coming into the policy playbook? That can significantly alter the way investors would look at India going forward.
Would you say you need some of that stuff for that delta?
I think so. I think that is something which people would want to see because, as I said, that valuations in their mind has obviously reached a point which is built in a lot of this macro good news and the policy continuity, political continuity. So to see a higher premium for India, we need to do a bit more is what my sense is.
Out of the 3 or 4 things you mentioned, which is the one most doable sort of reform in your mind or area which can be tackled?
So clearly, labor reforms is a place where we have already passed the bills in the parliament. They just need to be enacted on. And the privatization is also an area where we have made some progress and possibly with some political capital we can push it even farther. The more contentious ones are the land reforms and agricultural reforms because it affects a much larger segment of the population. So we will have to see how this can be done in a relatively less disruptive fashion.
You spoke about flows. Before bond inflows, etc. I'll come to that in just a bit. What about FDI sort of inflows? 2023 was not a great year. I mean, I think...
Again, the data needs to be looked at with some precision here. The actual gross FDI inflow is only down 7%. The problem is that the net FDI inflow is down 45–50%. That's because there's been a significant amount of repatriation out of India. And by the way, this trend in falling FDI, India is not unique here.
Sure.
Almost all EM countries have seen this. Part of the reason could simply be that higher interest rates in developed world might have made cash stay back there rather than being invested. But I would say that if I look at the trend in gross FDI flow, that decline is not that worrisome. 5-7% decline is par for the course, can happen from year to year, could well be reversed also. The question is that the repatriation that we have seen could be because, particularly in private equity venture capital world, there could be some profit taking in India which could have gone into rebalancing their portfolios. Are we at the end of that cycle? I think that's something what we need to watch out for as we move into FY25. So we have a slightly more optimistic projection for FY25 in our FDI flows, primarily because we think that large part of this repatriation process is already behind us.
Do you think it's behind us?
I think so. I mean, that's what is there in our forecast, especially when interest rates will be likely to be cut in the developed world in FY25. That's when there could be a renewed emphasis on bringing that money into the EM world, and India would benefit out of that. Also, I think there is a bit of a lag between this whole the China +1 discussions that we are having in the Indian context. So we are part of a lot of these discussions, but not as much of that has got translated into flows, which could happen with a lag in FY25 is what our belief is.
Okay, got it. On the bond flows, so this is JP Morgan index inclusion will happen this year, then there's Bloomberg index emerging market will happen next year. Cumulatively, what kind of flows are we looking at?
So it's tough to put a finger on a particular number because there are a whole host of issues here, including even how much is going to happen as a pre-positioning before the index inclusion per se. We've already seen about $9 to $10 billion of inflows into bonds from the September inclusion announcement date. So, but mechanically speaking, this number is supposed to be about $23 billion. Our suspicion is that it will turn out to be higher than that, not lower than that. And increasingly what it will do is that even funds which are not tracking this index directly, they will have a reason to start investing into India because of the market depth, liquidity, everything that this will bring in. In fact, that is probably the learning that I had in my recent conversations, that it's not just the index tracking funds that will be bringing in the money. It's often even the non-index tracking funds, including some of the global funds, which will start making some allocations towards India. And if we start getting newer indices like Bloomberg's or FTSEs of the world joining the party, then you could see this number to be even larger. But the only thing I would put a caveat on is that this is a one-time flow. From next year onwards, we are not going to get $25 billion
like
every
one stock
year.
adjustment in a sense.
It's just a one-time stock adjustment. From next year onwards, the flow could be 2, 3, 5 billion, but not really 25, 30 billion. So that is, fiscal arithmetic, we have to keep that consideration in mind as well.